So that's why I think two things are happening in the United States. Inflation's coming down, and all that is baked in the cake because of these lags. Real economic activity and inflation and asset price changes come after, with a lag, after changes in the money supply. So we have inflation coming down, and I think we'll see real economic activity continue. It's starting to get soft, and it'll get softer as we end the year and go into 2025.
On this episode of What the Finance podcast, I have the pleasure of welcoming on Steve Hanke. So Steve is the Professor of Applied Economics and founder and co-director of the Institute for Applied Economics, Global Health and Study of Business Enterprise at the Johns Hopkins University. So Steve, thanks so much for coming on the podcast today.
Great to be with you, Anthony.
And I'm looking forward to the conversation. You are sort of at the forefront, I guess, of economics, and I've really enjoyed your other interviews. So happy to have you on. But where I start with all our guests is just asking, what is your current outlook on what we're seeing, I guess, in the US and global economies?
Well, let's take the two big elephants in the room. I mean, the two biggest economies in the world are what? The United States and China. And if we look at the United States, we have had a monetary contraction. The stock of money in the U.S. system now, when you measure money broadly by M2 in the United States, it's actually lower than it was in July of 2022. Now, we've only had 4 other occasions where we've had contractions in the money supply since the founding of the Federal Reserve in 1913. And those are way back there. We got to go back to 1948, 49. We had one then. 37, 38, we had another one. And then, of course, the big one in 1929, 1933. And prior to that, 1920, 1921. So you have to go way back to find one of these contractions. And every one that's ever occurred, we've either had the Great Depression in 1929, 1933, or a pretty good recession. So that suggests to me that we will have a recession, and it's baked in the cake because, of course, economic activity lags behind changes in the money supply. So if you get a change in the money supply, then with a lag, a long and variable lag, you get changes in economic activity and changes in inflation. So in the U.S., that's my outlook is for early in 2025. We'll probably be in a pretty serious slowdown and recession. China, let's move to China. So China actually is coming in lower and many more problems than people anticipated. And the money supply there, again, is growing lower than the golden growth rate. Hanke's golden growth rate is 9%, roughly 9% for China. Now that would be a rate consistent with hitting their inflation target of about 3%. So their current growth rate in the money supply is running about 6%. It's been a little below the golden growth rate for some time. So they're struggling. So both countries are hitting, a patch of rough water because of the money supply problems.
Okay, thanks for laying that out. And what is causing, I guess, the money supply shrinkage? Is there anything that you're currently seeing doing that?
Well, the big thing in the United States is the fact that the Fed, remember, the COVID pandemic hit in early 2020, February of 2020, and the Fed accelerated the money supply, and actually in February of 2021, it hit on a year-over-year basis an all-time high of about 27% per year, and that was followed, of course, with a high inflation. It was John Greenwood and I, using the quantity theory of money and looking at the money supply, we anticipated that it would go up as high as 9% per year in the United States. It went up to 9.1. And then, of course, the Fed does what? It starts slamming on the brakes with quantitative tightening and a significant increase in the federal funds rate. So we've had tight money and this contraction in the money supply, over tightness, and that's where we're at today. And inflation, by the way, is of course falling. It's at 3% per year in the United States, and I anticipate Greenwood and I have modeled this and think it'll come in at 2.5 to 3 by the end of the year. So we're already kind of in our sweet spot in our zone. Again, looking at the money supply, what happened in the money supply in previous quarters and years affects what's happening today in the United States and every place else too.
Yeah, and you mentioned quantity or theory of money there. So can you maybe explain to the audience what that is? Is it just what you've been talking about now?
Well, the quantity theory of money, in the simplest terms, the quantity theory of money says that the money, the stock of money, is the fuel in the economy, and if that goes up significantly, what happens? It's followed by the nominal GDP, and remember, nominal GDP has an inflation component and a real component. That nominal GDP will go up. So and that's what we had. I mean, we had this huge increase in the money supply, and what happened? With a lag, nominal GDP went up. The inflation went up, that component went up, and so did real GDP. And by the way, so did asset prices. Asset prices are also affected by this fuel in the economy. And if you look at it in a more technical way, it's the old equation of exchange, the identity, and that's M for money, V for velocity, equals P, the price level, times Y, the real rate of growth in the economy. And if you put that into logs and differentiate it with a differential equation, you just get M plus V equals P plus Y. And then if you solve for M in the thing, you're going to end up with the golden growth rate. You got to, of course, flip V over to the right hand side, so it's minus V on the right hand side of the equation. So it's M equals P plus Y minus V, and V is always a negative number, so it's a plus. And in the United States, what do you get? You basically get the potential growth rate. Let's say is roughly 2%. That's the Y, and the P part is the target is 2%, and the velocity is roughly at -2, so it's 2 plus 2 plus 2 equals 6, or maybe a little under 6, and that's the golden growth rate for the U.S. economy. And now the money supply growth rate on a year-over-year basis, it's only growing at 0.6%. So it's way, way below. We've not only had this contraction in the stock of money since July of 2022, unusual, as I said, almost unprecedented, and we still have very anemic growth in the money supply, under 1% a year on a year-over-year basis, and it should be about 5 or 6%. A rate that's consistent with hitting the Fed's inflation target of 2%. So that's why I think two things are happening in the United States. Inflation's coming down, and all that is baked in the cake because of these lags. Real economic activity and inflation and asset price changes come after, with a lag, after changes in the money supply. So we have inflation coming down, and I think we'll see real economic activity continue. It's starting to get soft, and it'll get softer as we end the year and go into 2025.
Okay, makes sense. So, you mentioned previously that the central banks, they previously used to look at money supply, but it's not something that they look at anymore. Why do you think they've sort of changed or shifted their focus away from it?
I think that they're kind of two things. One big thing, and that is the models they use are what we call post-Keynesian macroeconomic models, and those models don't include money. The main post-Keynesian models don't include money at all. So the theory, it's just been ripped out of the macroeconomic playbook. So that's one reason. You have all the younger economists. This has been going on for about 30 years. So all of the rather recent arrivals in the research departments at these central banks, they don't have models that use money. So that's one big thing. The second thing is that they claim in the United States anyway, and the UK, this has been the same thing in the UK. They claim that this equation of exchange thing that I said, M plus V equals P plus Y, they say that doesn't work. Well, it certainly worked for John Greenwood and I. We're one of the two people who got the inflation right on the way up and got it right on the way down. And the central banks, none of them were able to predict anything. With these post-Keynesian models, they never got inflation. They never understood what inflation was all about. And they've come up with all these non-monetary factors that supposedly cause inflation. So one reason is the modeling, the theory. The second thing is a practical thing, and that is when inflation rears its ugly head, of course, that's a bad thing. People don't like it. It's a tax. Inflation is a tax, the inflation tax. And the central bankers always want to be in a position of saying, it's not me, it's the guy behind the tree. And to do that, you have to go to non-monetary factors that are causing inflation, not money, because central bankers are responsible for money and the money supply and the stock of money. So they want to get the monkey off their back. Once inflation starts rearing its ugly head, the central bankers want to take the exit door in a hurry. And the easiest way to do that is say, oh, this recent bout of inflation we've had, what's that all about? It's about supply chain glitches that we had. Remember about all that? We had all that talk about supply chain glitches. And they said, oh, now we've got those fixed and inflation's coming down thanks to the glitches being fixed. Or they say oil price increases caused inflation, or the war in Ukraine, or you name it. There's a plethora of non-monetary factors that they come up with. But this is all a great distraction to get the monkey off their back.
Yes, it's a way for them to shift the blame and reduce transparency, is what you're saying.
Yes.
Okay. Yeah, it's sad to think that we're in that world, but yeah, they're never going to learn. But you were saying before, yeah, that there sort of needs to be a 6%. So was it the Hanke Golden number or golden? Was it 6% growth for the
Yes.
economy, liquidity growth for the economy to grow? So
yeah, that's the U.S.
in the US. So we need
and
liquidity. Oh, sorry.
Yeah, if go ahead. Well, I was just going to, since you're in London, let me just get to the UK. Look, the UK see us more or less in the same boat as the United States. because they copy each other. These most of the central bankers do. Not all of them, but a lot of them do. Especially the Bank of England and the Fed. So right now, the golden growth rate for the UK is around 4.5%. It's lower than the US, and let's say it's about 4.5 or 5%. The US is about 5 to 6. The current year-over-year growth rate is 0.9% for broad money. The M4EX money supply measure in the UK, it's hardly growing more or less at like 1% per year. It should be growing at least 4.5% per year to be consistent with the UK's inflation target of 2%. The picture in the UK is somewhat similar, and that's why, of course, inflation's coming down. It isn't because these non-monetary factors have been fixed. It's because a year and a half ago, 2 years ago, the money supply starts going down, and as a result of that, with a lag, you get inflation coming down.
Is it possible for there to be growth, economic growth, without liquidity growth, or in your model, it's not
Well,
possible?
no, of course you can. It depends on when you say liquidity growth, we're talking about changes in the money supply, the stock of money, and if you change the inflation target, let's say instead of 2%, if it was 0, you could easily get the right result by just cranking back a notch or two on the growth rate in the money supply. And remember, monetary policy is what? It's about changes in the money supply. And the central banks aren't looking at that. Most of them. Now they're, and if you look at worldwide, what happened, by the way, another important thing to keep in mind is that inflation it's not a global problem. It's a local problem, depending on what the local central bank's doing to the money supply. And that's what we found in the pandemic. Greenwood and I've just looked at 27 countries that account for about 75% of the world's GDP, and you have one group that we have roller coaster rides where as you goose the money supply goes up, and with a lag you get inflation going up, and then they get scared and they tighten things up, money supply starts going down, with a lag inflation goes down. Well, the thrill was in places like the US, UK, the Eurozone, Egypt, Venezuela, Brazil. I could go on down the list. That's where money supply went up a lot and then came down a lot. Inflation went up a lot, came down a lot. And then you get other countries like China where things remain pretty much the same. And where did their inflation peak out? After the peak increase in their money supply, inflation peaked out after, as I recall, about 19 months with a lag at 2.1% per year in China. And there are other, the list of places where the roller coaster ride was not that wild would include not only China, but you have Japan, Switzerland, Malaysia, India, Indonesia, South Africa. The roller coaster was kind of mild. There was a roller coaster, but kind of mild. And the countries where it was wild and big, US, UK, Eurozone, Denmark, Sweden, Canada, Australia, New Zealand, Argentina, Brazil, Egypt, Ghana, Israel, Mexico, Nigeria, Peru, Philippines. So I just ticked off the 27 countries involved, but again, inflation is not global; it is local, and it depends on what the local central bank's doing to the money supply. And we found out, by the way, interesting, the lag was very consistent. The lag between changes in the money supply and the peak of the money supply and then the peak of the inflation that followed, that part was interesting for us because long ago Milton Friedman in his studies of inflation and changes in the money supply in the United States found that the lag, it was about 24 months. And what did we find? We found that the mean change, the average lag was 23.9 months, and the median in those 27 countries that we looked at, median lag was 23 months. So it was more or less right on what Friedman had found a long time ago. And as you could see, the mean and the median are almost the same, so that there's not much dispersion in the lags that were occurring. They were almost all the same.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views with hundreds of thousands of different people listening in. So I just wanted to thank you. You know, I started this as a student. I'm now currently working and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening. And let's get back to the show. Okay, so that's sort of suggesting, as you were saying, sort of at the start of our interview, that the US looks like it's going into recession, and we're seeing that sort of the lag coming into effect.
Right. And Anthony, the problem most people have, they look at contemporary data and they fail to realize that the movements in the contemporary data that they're looking at, they're caused by changes in the money supply that happened a year ago or 2 years ago, or maybe even 3 years ago. Now, for somebody who's paying attention to the money supply, of course, this is very valuable to be looking at changes in the money supply, because whatever happens, we know with these lags between changes in the money supply and changes in economic activity and inflation, we know those contemporary changes, they've been baked in the cake a long time ago. But most people get all crossed up with it. They're just looking at contemporary data. They're not looking back, and they're certainly not looking at the money supply. Most people.
Okay, so judging by this money supply that we see in the past, how bad do you think this recession could get?
It's really hard to tell, because the magnitude of the recessions depends on a lot of other things going on in general state of business confidence. That's one factor. And the other factor is whether the Fed, the central bank in the United States, continues with quantitative tightening. What if the recession starts and they're still continuing with the money supply growing at an anemic rate, let's say 1% per year instead of 5 or 6. So
Okay,
it depends. It depends, and also so the magnitude is kind of tricky. and something I don't want to make a conjecture about where I think it might be the magnitude, and also the exact timing of this stuff. You can't tell with much accuracy exactly what the lag is going to be, because as Friedman found out in all these early studies that he did, as well as all the other monetarists, the lags are long and variable. So the variation depends on lots of other things going on. I think we're probably pretty safe by saying we'll start seeing a pretty good slowdown early next year. That's about it.
Yeah, and if we judge based on previous slowdowns, the Fed will sort of kick into gear, stop QT, potentially start QE, pumping money into the economy. And then how quickly, will there still be a lag before it sort of, I guess, permeates throughout? If they
Well,
were to put,
the
yeah.
problem with the Fed, they're always late to the party. That's why you have the roller coaster. That's why things do go up and do go down, and there hasn't been, there wasn't much of a roller coaster in the 1990s, up until the great financial crisis in 2008 in the United States. And the reason why is that the money supply. Remember, Greenspan was the chairman of the Federal Reserve at most of that period of time, and the money supply was pretty close to Hanke's golden growth rate of about 5 to 6%, and inflation was, hovering around 2%, little bit less actually.
Okay. Do you see them sort of looking to change, I guess, their models and how they act into the future, the Fed and other central banks, or do you think this is going to sort of just be a continual move in this direction?
No, I don't. I think they're pretty much in stone, at least for the time being. I don't, and they've so convinced everyone that all of the recent roller coaster has been caused by non-monetary factors: COVID lockdowns, supply chain glitches, war in Ukraine, all these other things that I think they basically gotten off the hook, and they'll just keep doing the same thing as that they're doing.
Yeah, it seems like that's the way they're going. So what economies are you positive about? In the near term, or is it a lot of economies moving in the same direction as the US?
Well, one that had terrible monetary policy and terrible problems, and they have gone back to, shall we say, more orthodoxy, is Turkey, for example. I think Turkey's kind of turned the corner. The official inflation rate's about 70%, but I measure it with very high frequency data daily, and the number that I have, it's down under 30% per year, and my inflation measures always lead the official inflation measures. So that means inflation is going to be coming way down in Turkey, and I think Turkey will be one place that's actually turning the corner and looks a lot better than it's looked in the last few years. So that would be one kind of dramatic case where I think they've turned it around, and I think with my inflation numbers, with the high frequency data I'm using to measure it, I think I'm pretty much ahead of the curve. And again, to me, it's more or less baked in the cake. So that would be one, but there aren't too many. I mean, it's you really have to scratch your head to say, who's really turned the corner and coming out of things and looking good. China doesn't, Japan doesn't, U.S. doesn't, the Eurozone for sure doesn't. So we're talking about, like almost 70% of the global economy. It looks like it's more or less treading water, and maybe we'll go underwater. So, anyway, but so you have to go to these specialized little countries.
Okay, yeah, that's a scary thought when you put it like that. So one thing that's sort of come into play recently, and I guess you could say since Donald Trump came in, there was a focus on, especially in recent history, there was focus on sort of, I guess, trade wars, potential tariffs. Biden's continued that, and Trump's come in and even mentioned that he wants to increase the tariffs even more and potentially put a blanket tariff over all imports into the US. So, from your perspective, what impact would this have on the US economy and other
Oh, it's
economies globally?
very negative, very negative. Uh, and it's just not the United States. I mean, you go to the UK and Europe and China, every place. We're in kind of a quasi trade war with this protectionist mentality, more or less sweeping the globe. So it's highly negative, and will lower the potential growth rate in all the countries involved, in varying degrees, depending on how bad the tariffs are. But remember the Great Depression. Go back to that period, 1929 to 1933. And what happened to the money supply? The money supply then contracted by 38.8% in the United States. And we had a Great Depression lasting 43 months. Now that's part of the picture. The other part of the picture, a very important one, is the Smoot-Hawley tariffs. They came at that time. This kind of protectionist mantra was being used in the United States, and it spread throughout the world. Once the U.S. imposed the tariffs, there were counter tariffs in other countries. So half of the Great Depression, a big cause, and an elephant in the room in a way, was something people don't even remember or talk about, and that's the Smoot-Hawley tariffs and protectionism. So we're playing with fire with this protectionist thing.
Yeah, let's hope they don't go in that direction. So we've mentioned money supply quite a lot throughout the interview because it's, as you mentioned, it has such a big impact on the economy. Does it have a similar impact on markets and sort of how they react?
Well, the big thing with the markets, let's say the market in the United States, with a slowdown in the economy, of course, revenues go down to firms, and ultimately profit margins go down and profits are reduced, and the earnings picture becomes not so bright, and right now all the earnings forecasts are quite bullish and positive. But if a recession starts cutting into those, which it will, we'll have, I think, a big correction in the stock market. The price earnings ratios are going to come down. The multiples will come down in a recession. They won't go up, and they're very high right now. The market's very pricey. There are very few cheap stocks to buy. There are almost none. They all have very elevated price earnings ratios. They're expensive. So they'll become less expensive with a recession. It's just an earnings game. I mean, earnings forecasts will just they'll adjust them and they'll come down. And once that happens, the PEs will start coming down.
Yeah, I better save some cash then. But yeah, Steve, thanks so much for your time today. Really appreciate it. My last question is, what is one message that you'd like people to take away from our conversation?
Well, I think the main thing, given what we've been talking about, Anthony, is that people have to learn how to keep their eye on the money supply, what's happened to the money supply, because the stock of money is the fuel for the economy. And when I say the economy, I'm talking about nominal GDP. That is inflation plus real economic growth. That's a nominal GDP. So keep your eye on the money supply. Changes in that are going to cause nominal GDP to change, and that causes all kinds of things to change. We just talked about one of them, earnings. If nominal GDP goes down, top line revenues are going to go down in general, and earnings are going to go down in general, and probably you're going to have PE adjustments downward, simply because I think they're quite exaggerated now, because people are projecting ahead very strong earnings growth. And if that strong earnings growth isn't in the cards due to the fact that a long time ago the money supply started contracting and is working its way through the system with these lags, people are kind of sleepwalking into this because they're not looking, haven't studied the money supply. And so that's the main lesson we have for today.
Great message, Steve. Thanks again. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
I think that one thing for kind of real time is Twitter. It's at Steve _Hanke, and I've got 750,000 followers, and put up things. A lot of things we're talking about today go up on a regular basis, or they can get on my distribution list by just sending me an email at Hanke, HANKE, at jhu.edu, and I'll put them on the list.
Perfect. I'll put that in the description below, but thanks again for your time.
Thanks so much, Anthony. Great to be with you.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.